Welcome back in, investors. So we did a live stream last night and it was on Tattooed Chef's earnings. And what I'm going to do today is just break down that live stream to about a few minutes here, as that was almost a 3-hour live stream, a lot of Q&A, and a reaction to Jeremy's financial, whatever that was about his thoughts on Tattooed Chef. So if you want to catch that, I'll leave it linked up here. So as we can see, guys, it broke down. It's at $2.75 roughly. And, we talked about it breaking down to $2 on the live stream, and that's what it's doing today. So what is really wrapped up with Tattooed Chef? Well, I listened to the conference call and I went through the earnings, and here's what I have to say. Not only were the earnings a complete disaster, but as we can see here, they did announce that they intend to raise additional debt or equity cap in the near future, which, guys, that usually means diluting the investor, putting more shares on the market, as their balance sheet is in a critical state. They do expect to be positive EBITDA and free cash flow by 2024. Guys, I don't trust it. I listened to the phone call, and they don't know what their margins are going to be in 2023. If you have no clear path to the next year, how could you have an idea what your path's going to be the year following? So I consider that to be a massive, massive red flag, ladies and gentlemen. And I think they stated this to stabilize the price, as they look to be diluting in the near future. Just my opinion, not financial advice. If you own the stock at this point in time, really hard to say what to do here. I have no advice for anybody that owns the stock, anybody that's interested in buying at these levels. I would just wait a few quarters here, see if they can get their balance sheet cleaned up, wait for the diluting to take place, as they are in a financial hardship position right now. I just don't see anybody lending them capital, as they're burning money. It just doesn't make any sense that anybody would lend them capital. It's just too much of a liability. Now, they could use their facility, I guess, as some sort of collateralized loan, but with interest rates where they are, I just think it makes sense they dilute. And so therefore, I'm leaning towards, in the near future, seeing a lot of shares hitting the market. Huge problems right off the bat, guys. Net revenue is coming down, and we're paying for a growth company. So it tends to need to go in the other direction if we're paying for growth, and it needs to go in the other direction substantially. The fact that they adjusted their revenue down is a massive, massive problem. Reason being is their margins are also coming down. So not only are they losing from the revenue, they're losing from the margins, which makes their 2024 story a little harder to believe. Along with that, if you believe we're going to be heading into a recession, they did state on the phone call that they are raising their prices by 10%. And I just see less people actually buying the product at these price points. I just not so sure that a $5.50 mac and cheese bowl made of cauliflower is going to be the first thing people run to in the frozen food section. More problems I see here, obviously, is their cash position coming down substantially, guys, from 92 million down to 14 million. I'm expecting some sort of capital raise here really, really soon. Another problem I'm seeing is that they do not have as many accounts receivable, which is going to be future income for the company. That's actually down. You want to see that start going up. Along with that, inventory levels look to be elevated, which they actually said is an asset on the phone call. I don't see this being an asset. I would rather see inventory levels a little bit elevated, but accounts receivable much more elevated. Biggest problem of them all is cost of goods sold went up over $40 million in the 9 months trailing. And we can see here that revenue only grew from 155 million to 179, and now the cost of goods being sold is exceeding what their net revenue is, and this is a huge problem. Now, once again, on the phone call, they did state that they believe they can get their costs down roughly 30 to 40 million. But still, when we bring it down to a bottom line, the net losses were still exceeding $86 million. So even if they do get this adjusted, I'm just not so sure that it's really going to get them into the positive cash flow and the positive EBITDA that they were talking about on the phone call. A lot of things I have questions with that I just don't see happening for the company. Obviously, guys, once again, this is just my opinion. When we bring it down to a per share basis, last year they lost 93 cents. This year they are losing $1.05. As far as diluting goes, guys, I think you better be ready to see a little bit more shares on the market, as we can see here, going from 81.4 million to almost 83 million shares outstanding. So there is diluting taking place, and I tend to believe there's going to be more on the horizon in the near future. Another big red flag I want to pay attention to, guys, is the stock-based compensation has skyrocketed, going from 4.3 million in stock-based compensation to now 10.5 million in stock-based compensation. When we bring it down to a bottom line in the trailing 12 month and use adjusted EBITDA, we now get 16 million in losses last year versus $63.6 million in losses this year. So what kind of price target would I personally put on Tattooed Chef? Well, we obviously know this is no longer a growth story in my opinion. Can they still grow double digits? I'm going to give them the benefit of the doubt and say over the next 3 years, even if we go into a recession, they're somehow going to figure to grow around 15%. Now, this is a company that has been averaging over 50% growth rate. So, with a few bad quarters, am I being too hard on them? I don't know. Let me know in the comments, guys. And also in the comments, let me know if you own the stock, if you're selling, if you're buying, what you're doing with your current position. For EBITDA margins, guys, I'm using minus 10%. They're obviously worse than that right now, but I'm hoping by the third year, which comes out to be 2024, where they think they're going to be cash flow positive, and I don't think that's going to happen. I tend to believe that they will be closer to possibly getting cash flow positive in 2025 and 2026, if they have any shot of being cash flow positive. From years 3 through 6, I'm using 11% growth rate. In years 6 through 10, I'm actually going to use 7% growth rate. Increase in shares, I only have at 6%, but I think this is going to get a lot worse. I'm just going to build some safety in here and just say it's going to be 8% year over year share growth rate, as I do tend to believe they're probably going to add somewhere between 10 to 15% shares on the market here in the near future. And going further, I'm not so sure they're going to need that many shares if they can execute the way they say they can execute. But mind you, they have never executed the way that they said they were going to execute. So for whatever that is worth, just trying to be as open-minded as possible. And when we bring that over to a final price, I'm using a 9-time multiplier. Now, just to give you guys an example, most companies in this sector trade between a 10 to 13 EV to EBITDA, but with the concerns of this company, I think it has to trade at a discount, so therefore I'm using 9. And for me, guys, I get a $1.36 fair price target for the company, with the hopes of it being worth a little over $2 by 2030. I know this sounds crazy, but I have been on top of this one. So as always, guys, appreciate your time. Thank you so much for spending it with me. Make sure you smash that thumbs up, and we will see you next time, investors. Peace.